Hey future millionaires, this is Phil from Next Chapter Financial Solutions and Services. And in this video, we're going to go over 10 bad habits that we need to break because they're stopping us from achieving our financial goals. These goals are not limited to saving, investing, building wealth, and living a life of your dreams. Before we jump into it, please take a moment to like, subscribe, and share. And also at the end, drop a comment. Thank you so much, and I hope you enjoy the video. The very first item that's stopping people from building wealth is not having a clear plan. So it's really important to have a clear plan of what you want to do to build wealth. The simple statement of getting rich or even having enough money to retire is not enough. It's a start, but it's not clear enough to help you through the tough times. You need a detailed perspective of what you really want, and then the short-term steps you need to take to get there, and then the long-term steps you need to get there. The short term should obviously build and put you in the right step to meet those long-term objectives. By having a good detailed plan and picture of what you want, it will help you when there are distractions. And believe me, along the way to building wealth, there will be distractions. So you want to break this habit. Get really clear of what it looks like for you. If it's you and you're married, you should have a combined picture of what you really want your wealthy life to look like. So it should be very detailed. You should have an understanding of what it looks like on the monthly and quarterly basis, and really focus on the big items that could really distract you. Think about it from this way: the big expenses annually. Quick examples are how frequently you want to take a vacation, your car needs, your home needs. These big items will really have an impact on how you do expenses, and then conversely, expenses will have an impact on how much percentage-wise you're able to invest. Moving into item number 2, and which connects to investing, having a clear perspective of what your risk tolerance is. If you don't have a good understanding of your risk tolerance, it's going to be hard to invest consistently in the right areas for you. If you have an investing perspective that says, I want to target making 5% and under per year while I'm trying to build wealth, then you're going to have to probably invest more to reach a bigger number because your compounding rate is under 5% or around 5%. But if you have the investment target of having a risk profile that tells you that you want to go for 10%, then that means you're going to be in a riskier area, not crazy risky, but riskier. And you're going to have that tolerance to understand that those risks will drive you to have months or even quarters where things go down, but you're still consistently investing. And then when they go up, you see the appreciation within that asset class. The number 3 item is trying to time the market. The idea of always consistently buying low and selling high it sounds great on paper, but it's extremely challenging to do that. It's really not a great idea to try to time the market frequently. In fact, many studies have shown that dollar cost averaging, or DCA, is a much better way of doing this because it leads to more consistent investing. And that's really more important than trying to time the market for the average investor, that is. The 4th bad habit that you want to break is chasing past performance. Historical gains and losses, they can give you a perspective of what can happen, but it's not an absolute of what will happen. That's why whether it be ETFs, mutual funds, or even stocks, and when you're working with investment people, you're always going to hear that disclaimer, that famous line: past performance does not guarantee future results. And that's something to really keep in mind. It's not a guarantee. The 5th bad habit is failure to diversify. The activity of not diversifying puts all of your money or too much money in one sector or too much money in one type of asset class. And if there's a big correction in that asset class or that investment sector, you're going to feel all of it. But if you split things up in 2, 3, or even 4 big categories, the likeliness that all 4 go down to the same percentage is pretty low. It's possible, but it's pretty low. And even then, if it goes down, especially if you're years away from retirement, that's okay. You're just buying cheaper then. If it goes down for a whole quarter, your quarterly prices that you're purchasing at that month are going to be really low. So you're buying on the low. And that's why we brought up dollar cost averaging about 1 or 2 points ago. Number 6, letting fees hurt your returns. When you buy investments in a very expensive manner and you're not being conscious of the broker fees or the commissions to make the purchases, you're basically making your money work less effectively. So these excessive fees and transactions fees can really hurt returns over the course of time. So it's a great thing to do research up front to see if there's a lower cost alternative that has extremely similar past results. That's a great way to get very good results and pay less in fees. But keep this in mind as you're selecting your brokerage firm and the asset class which you're looking to buy things. Number 7, bad habit that people fall into is not rebalancing their portfolio. You really do need to be very cautious of this. So that's why we're always saying, check what you have, you're invested in, monitor your investments monthly, perhaps even quarterly. Now, if things go out of whack by 1-2%, that's probably fine. But if all of a sudden you wanted to have a 50-50 portfolio, 50% equities, and then 50% bonds, and there's a big, huge shift, and you went to 75 equities and then 25% bonds, you probably need to reallocate, because that big shift of 25%, that exposes you to a big correction if there is one. The number 8 bad habit is emotional investing. So that's really just going purely off of investing out of fear and greed. You don't want to do that. You want to stay consistent and disciplined, and you want to be buying on the rules that you set for yourself, which is why we always tell people, if you can, manage your budget in a way that you're investing per paycheck, whether that be weekly, bi-weekly, or even monthly. And you stay disciplined with that perspective, because you're investing for the long term. You're investing for big future perspective and usually retirement. So number 9 is investing inconsistently. So, but as an overall, we talk about investing. A lot of times investing, you should be investing for the big long term. So that is investing for retirement. That's investing in perhaps index funds if you're saving up for a long period of time to make a big purchase of a property or something of that nature. But investing inconsistently means you're investing maybe once a year, only once a quarter. Obviously, for a small business owner, that might be okay. But for everyone else who's employees, if you can, one of the best ways to do this is to invest per paycheck or per month, depending on what your budget can handle. That way, you're dollar cost averaging, and you're taking full advantage of compound interest over the course of time, and even over the year. Consistent investing over the years will really build up to a big, large dollar amount. And it doesn't have to be a lot if you start early. The number 10 bad habit that we've got to kick is failing to review and assess and adjust the plan frequently enough when necessary. So it's really important to review your plan, review the results, and make good decisions based on facts, not gut. So factual decisions will help you meet your overall strategy. So it's important to do this as frequently as maybe monthly, but at the bare minimum quarterly to annually, depending on what phase you're in. And monthly things, think of it this way. If you're trying to save up for a car over 3 years, and you're trying to do a monthly savings of a certain dollar amount per month, so check, confirm, are you achieving that goal of saving the right dollar amount per month? Now, if you're thinking about you just want to see growth on an investment account, you should be checking at least quarterly and then move into annually, because you want to automate your investing. So automatic transfers in, and then automatic investments of those transfers into the investment account. And then from there, you're just monitoring returns and then rebalancing. We've covered this already. So again, failing to review and assess your budget, your plan, is a bad habit that you need to kick if you want to build wealth. We hope you reviewed this review of 10 bad habits you need to kick, resolve, and watch out for as you're trying to build wealth and achieve your financial goals. Thank you. See you in the next video. This video is brought to you by Next Chapter Financial Solutions and Services. So please like, subscribe, and share with your friends. If you enjoyed this video, also drop a comment. It is our goal at Next Chapter to provide you with information to help you take action to improve your financial situation. Please check out our links on our Etsy page for printables and files to help you take action. We also offer one-on-one coaching. Our goal is to help our customers determine a clear path to achieving their financial goals. So if this is something you are interested in, please click the link below to contact us. Talk to you soon, and I hope you enjoyed the video.